The key is that every analysis should start not with what can go well, the reward part, but with the risk part.
Hello, Sven. Thank you a lot to be here with me. For those who don't know, can you quickly introduce yourself?
My name is Sven Karlin. I have a value investing channel on YouTube, and I have a research platform where I share research on various stocks in Britain that I analyze. I am a book author, and before that, I was a finance and accounting lecturer at the University of Applied Sciences in Amsterdam. I have a PhD that I did in stock market risk analysis, developed a model, compared it to the others, Fama and French, and that's the story. Usually, always been connected with value investing. Have been investing since 2002. Did pretty good, and now I'm happy to share that with the public.
Nice, thank you a lot. Before we go deeper into details in your strategy, can you tell us how you become passionate about value investing and about finance in general? I know that you love fishing, you love good businesses. Can you tell us more about that?
When I was 18, I was fishing. I was fishing those worms that you put and selling those, and the extra money that I made, a few thousand. When I was 19, 20, I looked for investing, and my goal was to get to 1 million of Croatian kunas, not euros, to 1 million, and then live off a 5-6% dividend, which for me was all the richness in the world. And I looked at stocks, and I saw some stocks. Okay, this has, I don't know, 5% dividend, and there was one when I bought it had a 30% dividend. And the only issue was that everybody was afraid that it will be delisted, but I said with a 30% dividend, who cares? And so I started reading and learning more and more, and I was a value investor from the start, and just followed on that note, because I was always looking for safety, dividends, good businesses that will be there no matter what. So that was the start, and later it developed into everything else.
All right, thank you.
But the dream was, okay, have 1 million and live off dividends. That was how everything started.
And be fired, financially independent, retired early.
Yeah.
As many people today. Yeah, very interesting. And before we go into detail in your strategy, can you quickly summarize your stock picking approach, your stock picking strategy?
It's not really stock picking. It's more when you are in a place where you can really invest your money. It's more about owning a business. So you like this business, and you see that the business fits your goals and your financial goals, and you say, if I own this business for a certain amount of time, of course you have to follow, businesses change and everything, then you say, okay, this is at that price is correct for me. And over the long term, stock prices usually follow the fundamental development of a business.
And this is what you demonstrated during your PhD, isn't it?
That was more on numbers and analytics, more about price to book and other 30 factors that we look. But yes, those factors again represent the business, and over the long term, the longer period you take, the more there is connection between the fundamentals and
the return
and the stock price in the long. Short term, anything can happen, but long term, that is it. For example, over the last 10 years, Google's revenue increased 7 times, and the stock price increased 7 times. Sometimes it's 8, sometimes it's 6, depends on the volatility, but the line goes in connection with the revenues. So always investing is about finding businesses and that are growing, doing well, with safety, that will do good.
And this question of margin of safety, it's always a debate in our area. So what is your process to calculate and to evaluating the margin of safety?
That's easy to talk about, extremely difficult to do. So over the last 5 years, as I was doing YouTube and research and everything, I must say that I have uh, unconsciously skewed a bit away from the margin of safety. I bought some growth stocks. I bought this. I bought because I was focused on risk and reward. So the reward is bigger than the risk, and the risk is there, but that is not value investing, unfortunately. So now I'm pausing a little bit and really starting to think about again whether that risk reward fits me or we go for the margin of safety. Because if you start looking for margins of safety in this environment, there is very, very little to find and invest in. But that is value investing. If you find one business in 2 years, you are happy. And when it comes to margin of safety, it is actual value of the assets. Can it be cash? Can it be something that we sold? Not intangible value. For example, if you take now a stock that's famous, Warner Bros. Discovery, with all the HBOs and movies and everything, they have 150 billion in assets on the balance sheet. But of that 150 billion, 50 billion is goodwill from the merger, and 50 billion are movies that they say they are that valuable. So you never know whether just a number on a balance sheet is not really a margin of safety. So you have to dig into and then see, okay, worst case scenario for the business, am I still okay as an investor? And if you can find the answer, worst case scenario, yes, I'm still okay as investing. I'll still be getting the dividend. The business will keep on growing, acquiring other businesses. Then you have a margin of safety, which is easy to say, very hard to find.
Okay. But yeah, I fully agree. I try to do my own criteria with it's like a PG better, but yeah, of course, it's always very hard to really put a number on the pure value of a business. Yeah.
You have to really, every business that you start with the normal numbers with price to book and everything, but then you have to go into the price to book and dissect the real value behind the accounting value. Some companies do very accelerated depreciation, and the value of what they have, for example, phone companies, cable companies, they do accelerated depreciation on the lines they have in the ground. And 5 years later, the value on the balance sheet is zero. But the value in reality is huge.
Yeah.
And that is then the margin of safety. So the balance sheet, you look at the balance sheet, looks terrible. And then they sell, I don't know, some towers, mobile phone towers to somebody, and they make huge profits because the value on the balance sheet is zero. They get $1 billion from the sale. So it's always about looking what's beyond those numbers.
Beyond the qualitative criteria. And what is your main qualitative criteria that ensure the quality of the competitive advantage, the management of the company, and all of these things?
The key is, it's always, when it comes to investing, it's always about money. So if the company has high margins, if the company has a competitive advantage, if the company is doing well, it makes money. Let's take Buffett's biggest position is Apple.
Yeah.
Apple, if you buy an iPhone, you are paying 25% profit margin to them, or what, 20%.
When way it's like 15, yeah.
It is stable over time, history, customers are buying. Recently went to Zurich, and there was a line in front of one store. It was in front of Apple store. So, and all that trickles down into they making 100 billion. So if you want one factor that to watch for everything else is how much money they are making.
Yeah, very interesting. I saw, I don't know, I saw that there are something that may wrong with Zoom. I think in 7 minutes we will have to cut it and rerun it. Sorry.
Okay, then we'll start the recording again. No
Just to say sorry.
No
And
worries.
of course, as a value investor, we are.
For example,
really,
excellent. This Zoom, leave it in the interview, because now we are not a paying customer to Zoom. After 40 minutes, we just restart again.
Yeah.
Of course, companies and everything have to pay but that factor shows that Zoom has weakness in the business model.
Yeah.
And therefore, the stock was risky long term. And then you say, okay, not for me, not value investing, no margin of safety.
And I'm paying Google. Like I wanted to do a Google Meet, but I didn't found the recording button, so I send you a Zoom link. But I'm paying Google. We are using Zoom, but I don't paying Zoom.
Okay, and then Google is the competition. Everybody is after them, and very hard to do in such a business. And I don't know whether they are making money now. If they would be making huge profit margins, huge cash flows, huge this, then okay, they have great business, great management, great moat, great everything. So at the end, it's always about those cash flows.
And,
which doesn't have to mean that they pay great dividends. Maybe they reinvest for growth, etc. But if you take Starbucks was profitable from shop number 1. And then they scaled it everywhere. There are so many businesses now that will never be profitable, but just bank on the hope of being profitable. And that's not, you're just complicating your life with that.
It's always the same during bubble.
Yeah.
It's the same story. We are thinking about growth and not about profitability. But at the end, of course, it's a cash flow. So 5 minutes. Let's talk a little bit about value traps, and after that, I quit Zoom and I send you a new link. Because as a value investor, we all are very, we all want to avoid value traps. But how to?
And as they say, of 10 value investments, 9 are probably value traps, because 9 businesses are cheap for a reason, and then you have to see whether that reason is already priced in. Again, looking at the worst case scenario, at the risks, compare it to the price, and then see whether that fits you. I've done many mistakes from the management. When the stock went down, as a value investor, you should buy more. And then the management says, okay, the stock is down 50%, we'll give you a 10% premium, and we are taking over the company because it is huge value. So the management can trick you. The book, what is said on the book values might not be there. So, so many things. The government can change a deal or a contract, and all the future profits are gone. Sanctions. So many things that can happen, and the only answer I have is the more you know a business, then you can start really understanding what will move. For example, I just made a video about Intel. It's a big company, so 2 years ago they were all about dividends, buybacks, and the P ratio was 10, and everything looked like, okay, this is a great investment for a 10% return. The stock price was 50, 60, and now it is in the 20s. So it was clearly a value trap, even if it looked like a great value investing with the buybacks, with the dividends, with the cash flows. So everything looked amazing. And now 2 years later, it is 50% down. What happened? The management changed course. Now it's a growth company, investing hugely, not doing buybacks now that the stock is cheaper. The dividend is still there, so that's 5%, that's still value, but there is a lot of uncertainty compared to that certainty. And that's something that can always happen. So Seth Klarman in the book Margin of Safety says that you have to be diversified, so that even if it is certain that you will make mistakes, And Peter Lynch says that he's happy with 7 out of 10 performing as he planned. And you will certainly make mistakes. That's a given when it comes to investing. And then it's up to you to see how, if you make a mistake, impacts you and how to deal with that.
This sharing about value trap, and I love your book Modern Value Investing about that, because you talk a lot about that, and there are not so many people who are talking about value trap, but it's so important because, of course, during all of our career we will meet value traps if we are focused on value stocks, and we need to talk about it. We need to talk about how to manage this kind of events and how to deal with it, of course.
That's why exactly I'm rereading again this for the 7th time. And the key is that every analysis should start not with what can go well, the reward part, but with the risk part. Yeah. What can go wrong? And that is value investing. And maybe 1% of the people that call themselves value investors start with that approach. Okay, what can go wrong? And you go by elimination, and then you find something that you can invest. It's very hard, I think, for humans, especially in the world we live. We are all about reward, and the key is to focus on risk first.
And even I have a little theory about that, because I'm like coaching a lot of entrepreneur and business owner, and they earn a lot of money, but the quality that they have to earn all of this money is not the quality that they need to keep it and to invest it, because you don't have to take risk. You have not to take risk to be a good investor. And this, and this like of shifting, it's really hard for them.
Yeah, the less risk you take, the longer term you can compound. Yeah. Because if you take risk, sooner or later it materializes, and then the compounding is gone.
Yeah. So thank you for all of this. Criteria, and with all of these criteria, how do you research stocks? What is your process?
I go simply, I look at everything in a sector or in a country. So, for example, I started being interested in copper in 2015, and I looked at every copper mining stock that is there. And I did that again in 2018, 2020. And now that copper investments are getting interesting again, I will go again through everyone, because looking at the others also tells you about the whole sector, the risk and reward there. And then you try to find the best investments there. So I simply go list by list. I did countries, the Netherlands, every company there 5 years ago. I did every solar company, every company in Brazil, and things like that. So I simply I recently did 3,600 small caps of the small caps index in the S&P 500. And of those 3,600, I got 3 companies that I follow, for example.
And are you using a tool like the one that I show you, or you are just doing that
really one by hand? As Warren Buffett says, you start with the A's, and that's it.
No screener, no. Wow.
No, because screeners are okay, but then the key is to know what's behind the numbers. The great investment will not have great numbers. The great numbers are usually a value.
Yeah.
Let me give you an example. Now every mining company has great numbers, low PE ratios, 10, 15, 20% dividends, because 2021 was a great year. And they have amazing numbers now. So if you put in a screener, the screener will be full of PE ratio of 5 and 10% dividends. You will look at that and you say, wow, that's a great business. But investing is about the future. And now their costs are up, the prices are down a little bit, so the margins went from 70% to 20%. So they're barely making money in the future. And that's why you have to go one by one and see, okay, this one will make 10 in the future, but now it's priced like it will make 2. And there you have a discrepancy in value that gives you a an investment opportunity maybe, but you cannot find it with a screener.
Okay, very, very interesting. I used to to use Screener. I used to code Screener by myself, and after that, I do a big work of qualitative analysis. But I'm very interesting about your approach, and thank you for sharing that, because this is helped me to improve myself, and this show me the point that I need to improve to be better. So thank you for this.
If you look at Peter Lynch, he was following 1,500 companies or something like that. And he always said the best time to invest is when the earnings start to improve, when that upward trend starts, and then catching the improvement, the growth, the everything. But you are going to learn about that if you read or listen to the conference call. Fortunately, these days you have all the transcripts of the conference call, so you can read, you can search through them, and then you see, okay, where is the business now, where they are going, and how will they deliver? Because from A to here, that's also the investment path if you can find it. Unfortunately, numbers help, but it is not said that this answer you can find in numbers from the past.
Yeah. Very interesting.
I think when I made my PhD, I put in 33 factors that I analyzed from balance sheets and cash flows and net income from 5 years prior. And it was I think I had about 30 stocks that I looked at to develop the model. And it explained about 30% of the stock price movements over 3 years, which is great, but just 30%, not more. And the shorter on a year, it wasn't significant at all. 3 months, 6 months, not significant. Over 3 years and longer, a little bit better.
With my screener, we are like screening with averages of 5 years for numbers, of course. But if you are just looking for 1 year of performance, of course, it's not relevant. And in terms of portfolio management, what are you recommended for the next decades and for yourself?
I currently own no stocks. So in August this year, I was really thinking about what I do and how I do it. And I sold everything, not because of the market, but because I was influenced by my business, by being on YouTube, by my research platform and everything. So I said, I need to take a break to really go back to the value investment, because it's very simple. If you have a research platform that you sell, if you have 20 businesses in your portfolio, if I own 20 businesses, I will sell more research platforms because more people will be interested in me following these businesses. And the incentive then is for me to have a large portfolio that is interested to people, and I get money by
show me the incentive, and I will show you the result.
And I understood that my incentive, even maybe unconsciously, is not good, and I have to take a break from investing, from everything, and then I will start. I also changed the tax jurisdiction, so also changing the business because taxes. So I took this, let's say, 3 months to really sort everything out for the very, very long term. So now I currently own nothing. I manage a small model portfolio with 7 stocks on my platform, which is my mother's and my son's money. That there is a clear strategy. So we own businesses that offer 10 to 15% or more long-term returns from a business perspective. I think there are 7 businesses in it. So, and every month we add a little bit, 250 euros, and we buy something that is the cheapest of the 7. So the strategy, and the plan is always to do 10 to 15%. And over the last 4 years, the portfolio did 13%. Now it's down. Now it looks best than ever. So I hope it will eventually, sometimes will likely go up, and it will do its thing. But then I started reading and everything, and I said, if I'm not connected to what I need to do for YouTube or for research platform, would I invest differently? started reading again a lot of books, and then I'm developing now how will I invest, let's say from 2023 onward, when the tax and everything sits into place, opening a business and things like that. So that is now, let's say, a search period for me and my strategy. The strategies that I used usually did good. Now I have to see, okay, good, is that good enough, or we can do better or not? I took too much risk in the past also, because I said, okay, this stock here now is a buy. For example, Intel now is a buy, but of course it can crash 50%. But if it can crash 50%, how big is the margin of safety? Shouldn't you just wait and do nothing till it reaches that margin of safety? And if you do nothing, you don't have a YouTube channel, you don't have a research platform. Now that I sold everything, I lost more than 50% of my research platform clients, because they want me to own something. If I'm not owning anything, they are not interested. And that incentivizes me to always do something, which is the opposite of investing. Sometimes in investing it's much better to do nothing and just say no. So I am now reading and really trying to put myself back personally to proper value investing, which is no risk, low risk, high reward.
And where did you go? What are you thinking about? More, are you more small cap oriented? Are you more? What is your orientation for these next years?
No orientation. Just when I find something, okay, this is now low risk for a good reward. That's it, and I'm ready to wait for a very long time to find that.
Okay.
For example, if you go, you can always look emerging markets or something like that, and those are much cheaper than developed markets. But then you say, yes, there is also a risk from currency, from this, from that. So you have to see, okay, how much risk are you willing to take, or if you're willing to take any risk.
Yeah.
And that's always the name of the game then.
I really love your mindset about this question of incentive and this question about the influence. I didn't know that you sold everything, and the question of the influence of your business on your portfolio is really true. Yeah. I feel it also, and it's very interesting.
All fund managers have the same issues. For example, a year ago, every fund manager started selling, especially if you're from the US, everybody started selling Chinese stocks. They had them and they sold them. Then I was thinking, why are they selling? The fundamentals are getting better and everything. No, they were just selling because they knew that they will lose clients if they had those in the portfolio. And so it is, the incentive is you need the client to make money, and you are incentivized to do what makes the client feel good, which doesn't mean that it is the most profitable thing for the client.
Yeah.
And that is a very dangerous incentive. And I knew it will hurt a lot that I sold everything. It will shock a lot of people. And but it is something I had to do. And we will start again without, hopefully, the influence, because I lost those clients that were influenced by that. I already lost them. So, but it was the only healthy way for me to go onward with this financial influencer business model.
Very, very interesting. Thank you for the inspiration that I get for you, and for the inspiration that you will give to my audience. For those who would like to know more about you, where can they find you?
I have a YouTube channel, so Sven Karlin on YouTube, and in every video in the description there are all the links to my book, to my research platform, to everything, and there is svenkarlin.com.
All right.